What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest in this episode is Nick Timiraos, the chief economics correspondent for the Wall Street Journal, where he covers the Federal Reserve and U.S. economic policy. He is also the author of Trillion Dollar Triage, an extremely detailed account of, in some cases, the day-to-day, hour-by-hour policymaking by Federal Reserve officials in the initial days of the COVID-19 pandemic and subsequently, between 2020 and 2021. The first part of this conversation focuses on the immediate concerns that investors have about Fed policy and the path of interest rates, including a discussion about inflation targeting and inflation expectations, personnel and the centralization of policymaking at the Fed, and trade-offs between economic growth, financial stability, and inflation. The second hour is where we get much deeper into a conversation about quantitative tightening, balance sheet capacity, and how this Fed would react to inadvertently breaking something in the plumbing of the financial system. We also discuss fiscal and monetary collaboration, the ability or inability to get inflation under control long-term without stabilizing government debt, the Fed put, the stock market, and much, much more. My goal in this conversation was to ask as many questions and learn as much as possible about how this Fed sees the challenges that lie before it, what data and information are most relevant to Fed officials when deciding how to set policy, how they think about trade-offs, and how Jay Powell specifically understands or thinks he understands the financial system and his role as chairman of the most powerful central bank in the world. I cannot think of anyone who is more qualified to answer these questions than my guest today, and I think you will find his answers and our discussion to be incredibly informative and valuable. For anyone new to the program, Hidden Forces is listener supported. I don't rely on advertisers or commercial sponsors. So if you want access to the second hour of today's conversation, as well as the transcripts and intelligence reports, which include my takeaways from every episode, as well as my thoughts on what comes next, head over to hiddenforces.io, select the episode that you're interested in, and click on the premium extras, where you can then sign up to one of our premium content tiers. And with that, please enjoy this excellent and deeply informative conversation with my guest, Nick Timiraos. Nick Timiraos, welcome to Hidden Forces.
Thanks for having me, Demetri.
So Nick, it's really great having you on. I've read your book, as you know, and I've been reading your articles like everybody else who's interested in anything central bank or Fed related for a very long time. You just published an article this morning, less than an hour before we even got on this call. And I was going to start my conversation with you asking you about the recent Jackson Hole Summit in Wyoming and what the atmosphere was like, what people were concerned about, et cetera. But since this timely article hit and since the subject of it is so relevant to our conversation today, I'm going to ask you about that to begin with. Now, in the article, you write at the very top that the Fed appears, quote, to be on a path to raise interest rates by another 75 basis points this month in the wake of Chairman Powell's public pledge to reduce inflation, even if it increases unemployment, end quote. And you also said later in the article that what's going to determine that is how much higher they expect to raise rates in the coming months and the steps that they need to take in order to get there. Why did you think that? How did you come to that determination? And what is going to determine whether they go for 75 rather than 50?
Well, that's a great question. I think the bigger question in my mind is, where is the ultimate destination? No one knows, of course, where they're going to end up, but you have a base case for where you think you're driving. And right now, it looks like, if you take the comments from my interview with John Williams last week, other public comments from officials, it seems as if they think they need to get rates this year above 3.5%, closer to 4%. Given where they are right now, let's say they're at 2.4, 2.5 right now is the upper limit of the range. So that would imply another 150 basis points of rate increases this year. If that's your base case, and it seems like that's a reasonable base case at this point, then the question for September really becomes one of, if you think you're going to do 150 and you have 3 meetings left, you could do 50, 50, 50, or you could do 75 now and then slow down to 50 in November and possibly 25 in December. And if the market is now pricing for 75, which it was yesterday before my story published, it seems like there's an option there to go ahead and do a 75 here. And so why not do that? The comment I think that Jim Bullard, the St. Louis Fed president, made a couple of weeks ago, there's a certain logic to it. He said, why would you drag this out into next year? If you think this is where you need to get, why not just get there more quickly? So I think that's going to be a consideration, because the September meeting is really, you're looking now at where you think the destination is. And if you have an answer to that, if you have a consensus around that, then it turns into a tactical question. How do you get there? And is it, from a risk management perspective, easier to go in smaller moves, or to have, again, a front-loaded approach where you sort of have a slowdown in the fourth quarter and you get to 4%, maybe you keep going, maybe you hang out there for a while. The data probably tells them, what they need. I think one of the challenges here has been the data so far hasn't been sending an obvious signal about 50 versus 75 for September. So they came out of the July meeting saying they were data dependent, and the data kind of can let you pick your own story here. The jobs report last week was a perfect example of that, where you had strong job growth. I mean, if we had taken that number, 315,000 jobs at any point in the 2010s, people would have said that's a gangbusters jobs report. Obviously, it's a slowdown from July. It's a little bit below the 380,000 monthly payroll gain over the last 3 or 6 months. And you did have the increase in the unemployment rate because of an increase in labor supply. But low response rate in this survey, probably hard to put too much on one report. So I don't think it gives a convincing, steer one way or the other. And then, of course, we get the inflation report next week, the August CPI report. The July CPI report was for once a downward surprise, right? Especially with headline. It seems likely that headline's going to be soft again. So the question really is what happens to core. But even if you have a soft core print, you only have 2 months right now of soft core prints after some very heady gains earlier in the summer. So I'm not sure that the data has been providing some very strong signal the way it did in June and the way it did in July.
So I have so many questions for you. Let's try to take the one by one or two by two. First, why 150? How did they come to that determination from your understanding? And why not drag it out? Because the question about why not dragging it out versus kind of front loading the hikes is really a question about how does this Fed determine setting market expectations. It's really a fuzzy sort of process. It's not like something that's empirical or certainly not data-driven when it comes to deciding how quickly to do that. It's really about how do we impact expectations. So tell me how you think about that. Why 150? How did the Fed officials come to this number? How do they think about, and why do they think about going front-loading versus dragging it out?
So there's been a huge focus since the July meeting on the need to get real rates into positive territory. That wasn't a focus earlier this year. Earlier this year, you heard them talking about the 2-year and how, even the markets are pricing in tightening before we act. And you see that in the 2-year. But since the July meeting, the focus now has been on the need to have and to maintain positive real rates. So you want to have, and the way a number of people get there, I think Chris Waller has said this, Richmond Fed President Tom Barkin has said this. They're looking at where they expect inflation to be about 12 months ahead and where they expect the funds rate to be 12 months ahead. And so they want the funds rate to be above the expected inflation rate 12 months ahead. When I spoke to John Williams, the New York Fed president last week, he walked through the math where he thought inflation was going to be around 2.5% to 3% a year from now. He thinks a nominal real rate is about 0.5%. And so a nominal neutral rate, you would need to be at least 0.5% above 2.5 to 3. So let's call that 3 to 3.5. And so if you want to be above 3.5%, if you think 3.5% is a nominal neutral rate in the current environment, then that would suggest getting somewhere closer to 4%. Now, you've heard others. I think Raphael Bostic's estimate is a little bit lower, but he's been at the dovish side of the committee. So you could say, maybe they need to get to 3.5 to 3.75 this year. But you're still talking about something closer to 125 basis points more in tightening. And if you listen to someone like Cleveland Fed President Loretta Mester, Jim Bullard from St. Louis, they're both closer to 4%. I think Loretta has been saying that she thinks rates need to get at least to 4%. So I think you kind of can see the goalposts there between the more dovish and the more hawkish committee members as 4%, give or take, 25 basis points, give or take 50 basis points. But it seems like that's where they're getting. That's how I'm backing out to 150 here.
So you mentioned John Williams. In a recent conversation you had with him, he seemed to suggest that the Fed's goal this time is to get rates to, quote, the right place. Now, usually the way that rate hikes have been justified in the past has been in part to get to a place where you can then cut if you need to. But it seemed from the conversation with Williams that the Fed plans to keep rates high even if it induces a recession. Is that the interpretation that you got from that conversation? And if so, how realistic is that if the recession is bad enough? And how do we think about when they might be willing to cut?
Clearly, they don't want to talk about cuts right now. I think one of the main discoveries we've all had after the July meeting, they said a number of things that the markets interpreted very dovishly or somewhat dovishly after the July meeting. And if you read the minutes to the July meeting, which the press conference, Powell's press conference, seemed to sort of reflect what was in the minutes, there were growth concerns. There were concerns about a growth slowdown. There was sort of an obvious statement that at some point we'll have to slow the pace of hikes down because I don't think anybody expects them to do 75 basis points indefinitely. But those sorts of mark-to-market comments were taken in a direction where investors bought risk after the meeting. And that is not something that the Fed wanted to see after that meeting. I think that's why you had the chair come out with a very short and to the point. I mean, it was an unusually brief speech at Jackson Hole. If you look at what Chair Powell has traditionally done in his Jackson Hole speech, it's usually been, 2,800 to 3,000 words. It's a little bit more of a step back. Here's where we are. Here's what history tells us about the risks on both sides. But you didn't get that in this speech. There was no nuance. There was no two-handedness to this speech. I sort of saw it as a statement of objectives. We can debate what the right tactics are to get inflation down, but this is what we are trying to do right now. Let there be no doubt. And so I really do think that was in part a response to the easing in financial conditions you had after the July FOMC. You heard from Reserve Bank presidents like Neil Kashkari in Minneapolis, Mary Daly in San Francisco, people who had traditionally been on the dovish side of the committee saying, that's not what we see. We don't see cuts. So they pushed back against the cuts story because to get a positive real rate, to have financial conditions stay tight, they can't have, people going out and buying risk thinking that the Fed is just about to call it time here on the rate hike cycle. I don't know if that answered your question, but I think that's part of what's been happening here.
Yeah, no, it answered part of it. And actually, this is a great opportunity for us to get back on script because I had a kind of a structure for this conversation that I had devised ahead of time. And this article kind of forced me to pivot a bit. But let's go back to Jackson Hole because this was something that I wanted to ask you from the very beginning because the Jackson Hole Summit is an annual retreat. It's been going on for, is it 40 years now or something like that?
45 years, 40 years in Jackson. Yeah.
Right. Since the early days of the Volcker administration. What was the atmosphere like this time, and what were people most concerned about based on the conversations that you were having?
Well, so the atmosphere, this was the first year they'd been in person since 2019. So when you get people back, doing things that humans are used to doing, like having meals together, people like that, right? We're tired of Zoom, and that's not much fun. And there was really good turnout this year. People from all over the world traveled. So you had, the governors of the Bank of Japan, Canada, United Kingdom, New Zealand. There was a very solid international contingent. I would say the mood was sober. right? This is the highest inflation that most of these central banks have seen in decades. Certainly in the U.S., it's the highest inflation since the very first Jackson Hole Symposium in 1982. So there was a seriousness about the meeting, and this is the first time we've had such high inflation with the current institutional arrangements that exist for fighting inflation, which is that you have a semi-autonomous, independent central bank with an inflation target. And we've never had inflation in this country that's this high with a 2% inflation target. So everybody kind of knows what their marching orders are. In terms of the substance of the discussions, I think there was a growing, recognition that the great moderation might be over. Some of these things that helped central bankers bring inflation down in the 1990s and then to keep it low, globalization, demographics, abundant sources of intermediate supplies, energy, that may not be something you can count on going forward here. And so if that's true, you have higher inflationary pressures. Augustin Carstens, the head of the Bank of International Settlements, the former head of the Mexican Central Bank, gave a lunchtime speech where he laid this all out, and he said similar things. Powell's speech got all the attention. It was the opening speech, but the closing comments from ECB board member Isabel Schnabel were very much worth your reading if you haven't read them, because it was a very strong argument for a risk management approach that would argue for doing more, that in an environment where it looks like inflation expectations may be growing unstuck, you want to respond forcefully. And you had asked me about Williams and this idea of cutting. I think we all began to understand quite well what the Fed's reaction function was when you were worried about low growth and low inflation. And, think exactly to where we were in 2019. Williams had sort of said, if you're close to the lower bound and you think you might not have much policy space and you see the economy weakening, you should ease aggressively right away. And that was what they did in March of 2020. Now, I think the challenge is, central bankers haven't had to develop their reaction functions, which is shorthand for how they will react to incoming data in an environment of much higher inflation or higher inflationary pressures. And central bankers, they get together 6 times a year at Basel. Those meetings have restarted. So when you get people in a room together and you're not on Zoom and you can have free exchange of ideas over coffee on the sidelines of a conference like this, I think that's important, because all of these central banks, most of them, not Japan, but most of them are all dealing with a similar challenge for different reasons. Obviously, the energy story is a bigger contributor to the high inflation in Europe and the UK, but they're all having to deal with trade-offs that they haven't encountered for a long time. So I think that's why Jackson Hole was so important this year, and important to have it in person.
Man, I'm really jealous of many of my guests at various moments, and this is one of those moments where you get access to so much information by virtue of your role. And to be able to be in that position, have these conversations, is such a privilege. So to that point, I want to really take advantage of our time, and I have so many questions to ask. One, just a clarification. It sounds like what you're saying is that since there seems to be this emerging policy consensus that the period of the Great Moderation is over, that the forces of globalization and other factors that led to this environment where you had persistent deflation, even in the face of lower costs of capital, that allowed the Fed to keep interest rates lower for longer, that this environment has changed. And so rather than the err on the side of being aggressive when it comes to easing, that policymakers may in fact have to be more aggressive when it comes to raising rates. Is that generally correct?
Yeah, that was the framework. I mean, go read the Schnabel speech. That was certainly the argument she put forward, was it's better to err on the side of overdoing it, because if you think about the mistakes you're going to make, hopefully everybody gets everything done perfectly, but that doesn't usually happen in policymaking. So I think a lot of the times monetary policy is about setting policy in a way where if you can fix your mistakes, and a fixable mistake is probably one that doesn't cause a recession or a financial crisis. So what are the risks looking ahead a year? The risk a year from now is either you raise rates too much and inflation comes back down to 2%, as the Fed thought was likely last year, that there is a greater transitory component to all of this. It's not as much demand driven. It is more supply driven, and the supply side of the world gets better. So the risk there is you find out that rates didn't need to get, to the high 3s or 4% or wherever they end up. And now you're talking about taking some of those back later in 23 or in 24, right? That's one risk. The other risk is you've discovered that actually inflation is more persistent and underlying inflation is closer to 4 or 4.5 or 5. And you have to resume rate increases after having stopped or paused for some time. Which mistake would you rather make? Stipulating you don't want to make any mistakes. That was sort of the way I interpreted Schnabel's speech.
So why is it that policymakers, and I'm also curious to know to what extent this is a consensus view, in other words, how much consensus versus division there is within the policymaking community around the view that we've moved past the period of secular stagnation towards a new secular period of inflation, or a secular period where the inflationary forces are more powerful. How do they justify that rationally?
Well, I think right now, when things are, looking very hawkish, it's easier to be a hawk, right? And so it's possible that we're not hearing some of the arguments on the other side, because when inflation's at 8 or 9%, it's just hard to say, well, slow down, maybe things are going to get a lot better. The argument I do hear on the other side is, look at China. China was an engine of strength for the global economy after the GFC. Property bubble looks like it's bursting. You could get some serious deflation out of the commodity space if the Chinese engine is really slowing down or downshifting to a lower gear. And maybe we'll all look back at the inflation fears of 2022 and say, well, that happened just as China was changing its growth trajectory and wasn't that silly. I mean, that seems right now like a good problem to have, just as in late 2020, the problem of too high inflation seemed like a lucky problem to have, because it would mean you were away from being stuck at the lower bound or negative interest rates and massive QE purchases for as long as the eye could see. You really only can focus on one of these things at a time. You can only fight inflation or deflation. You can't really risk manage to fight both at the same time.
So in the epilogue of your book, which I strongly recommend to listeners because the book is called Trillion Dollar Triage, it's not just about, most of the book is actually about the period of the pandemic and the Fed crisis writing response and also the role of the White House, which is also an interesting fact because it gives us an opportunity later in this conversation, Nick, to talk about what the role of the White House is and what the role of the fiscal authority is in helping to stem this inflation. But in the epilogue of your book, you pointed out that if inflation proved not to be transitory, and that if we were to find ourselves in a new regime characterized by not insufficient demand, i.e. secular stagnation, but by insufficient supply, that Fed officials would face a, quote, painful series of trade-offs. If the forces that contributed to the periods we referred to earlier as the Great Moderation and now as secular stagnation are over, what does this mean for Fed officials? What does it mean for monetary policy and for the types of trade-offs that central banks will begin to have to make in this new regime?
Yeah, so the trade-off is really one between growth, supporting stronger growth, or keeping inflation down. And during the period that some people call the Great Moderation, there was also this idea of a divine coincidence, which is that the same interest rate could achieve both stable, strong growth and low inflation. When you're being hit by persistent supply shocks as opposed to demand shocks, you think about what we had in 2008 as a demand shock, even 2001. But when you're being hit by supply shocks, the divine coincidence doesn't hold. You now have to choose whether to focus on bringing down inflation at the expense of weaker growth, a longer recession, maybe a deeper recession, or you support growth and you tolerate a higher potential period of inflation. And we haven't really gotten to a place yet, at least in the U.S., where the central bank has had to say how they're going to manage those trade-offs. I think we'll probably see it. It seems reasonable that we'll see Europe confront those trade-offs first because of what the war is going to do to energy prices and potentially inflation expectations. But that's the environment central banks could find themselves in now. What do you do when the unemployment rate starts to rise because demand is weakening, but you still have high inflation? And there are a number of people that I'm talking to, and these are academics, people like Ken Rogoff or Charles Goodhart, who are saying, look, if you get inflation down to 4%, or let's say 3.5%, you shouldn't try to cause a recession to get inflation from 3.5% to 2%. What's so terrible about 3% inflation? Jason Furman, the former top economist in the Obama administration, made this point from the stage in Jackson Hole. So I think the question here is, people are hoping and expecting inflation to come down, but let's say it doesn't come down all the way to 3. Let's say it comes down to 4. What do you do with 4% inflation? And then let's say it does come down to 3. What do you do with 3% inflation? I asked John Williams about this last week. I pointed out that, Greenspan, when he became chair in 1987, inflation was at 4%. It took about a decade to get it down to 2%. And John said, well, Greenspan didn't have a 2% inflation target. We do. We know that's our job. And so he seemed somewhat dismissive of what was then called the opportunistic disinflation story, which was that, Greenspan wasn't going to just, go guns blazing to get inflation all the way down, even though he did tighten rather aggressively and preemptively in 1994. So that's the trade-off is, how much of a sacrifice will you take on growth to get inflation down? And at what point do the trade-offs become so severe that you say, you know what, maybe we've done enough, even though inflation's still above 2%, we're going to take our time here to get back to 2.
Well, that actually raises two questions. One that I kind of mentioned earlier, which is inflation expectations. And the question is, really, how focused is this Federal Reserve on inflation expectations? Because inflation itself is a lagging indicator. And to be hiking this aggressively when other indicators are beginning to turn red, focused very much on inflation, suggests that they're really concerned about expectations, even though that concept itself is a bit fuzzy and we don't fully understand it. So that's one question. The second question, less of a question, but an observation, or maybe it's a question, which is how concerned is this Fed about credibility? Because just from my knowledge of the history of central banking, the Greenspan Fed in 1994 had much more credibility, even though Greenspan, the credibility that he built up over the course of his tenure caused the Fed to have even more credibility towards the end of that time period. But it still had more credibility, I think, than it has today, because in general, government institutions are seen to be as less credible. So how do those things factor in? One, the focus on inflation and inflation expectations in pushing below 4%, because that's the target. That's what they said they're going to hit. And two, how important is credibility and the perceived lack of credibility in institutions by the public in compelling Fed officials to again, push below 4%, even if we get down to that level and inflation seems, somewhat anchored?
Well, so there's a lot there. On your first question, how important are inflation expectations to this Fed? The answer is, I think they're very important. I think you saw that at the June FOMC meeting where they made the decision to dial it up to 75 basis points instead of 50. You saw a number of signs. It wasn't just in the University of Michigan survey, the preliminary survey that came out right before the meeting, but you saw break-evens had been rising after the May FOMC. So I think they're very attuned to inflation expectations. And when Powell was asked about this at the Sintra conference in late June, I think he was asked by the moderator there, well, what are you looking at to see if inflation expectations are drifting up or creeping up into the danger zone? And he sort of curtly said, the point is not to see it. So, yeah, I think it's very important to him. On the question of credibility, that's a great question because people talk about the Fed losing credibility. And I always wonder, I think the word is somewhat vague. If you're talking about credibility in the markets, now some people say don't even look at market-based measures of inflation compensation. The TIPS market has been so distorted by Fed purchases that you can't take any signal from that. So, but if you do think that there's still some value in market-based measures of inflation expectations, if you look at what investors are currently anticipating for inflation a year from now, they actually see inflation falling, CPI falling quite a bit to 3% or even to 2% by 2024. So from that standpoint, I think you could argue that there is credibility, or at least confidence in the market, maybe too much confidence that inflation's not going to be all that persistent, that it's not going to get stuck in the mid-4s. So I think when people say that the Fed isn't as credible as it used to be, what they're really talking about is forecast credibility, right? Because they got things so wrong last year on their inflation forecast. And, the whole economics profession shared, I think, maybe they took too much comfort from the Fed. Maybe they looked at what the Fed was saying and they said, oh yeah, I think that too. I think inflation's also transitory. But, there were a lot of people last year who argued that, it would be a mistake to respond to the price pressures that were building. And so obviously from that standpoint, and when the Fed is putting out projections every quarter, every 12 weeks, saying where they think inflation is going to be, and then people take that as a forecast, and then very rarely is the forecast actually what happens because things happen in the economy. So yes, from that standpoint, having a Fed that talks far more often than the Greenspan Fed did, that's putting out all these projections, it does risk some hit to your credibility, especially when you were as wrong as you were last year. And then I think the last piece of credibility, though, is, because to me, credibility is, do you do what you say you're going to do? I mean, that's really the way that you stay credible in the market. And that's why the Jackson Hole speech was, and these, all of the things that Powell said in that speech, I don't think it was the first time he had said any of those things. He may have said them more sharply than in the past. This comment about how there's going to need to be some pain, I think he said that in the interview I did with him in New York in May. So he said all of these things before, but he's saying them maybe with more emphasis. He's not providing sort of the more dovish, on the other hand, point. Certainly in Jackson Hole he didn't. But, when he says that's what he's going to do, I would take it seriously, because as I write in my book, there were times during the crisis, maybe the best example is in June of 2020, the Fed had made these commitments to purchase corporate securities. And they had said they were going to do it on March 23rd. They didn't have the tools yet to do it. They really hadn't built the capabilities to go in and buy corporate securities or ETFs. But they'd said they were going to do it. And then the market completely opened up just off of their promises. And he was asked in the June hearing by Pat Toomey, who was very skeptical of the need to do this now that the corporate bond market appeared to have been rehabilitated. He said, well, why are you buying securities? And Powell said, because we said we would do that, and you have to follow through on your commitments. So Powell here is making a different commitment, which is to bring inflation back down. And the way that you earn back your credibility, to the extent that you've lost it, is by doing what you say you're going to do. And credibility is, from what I've observed with the Fed chair, and as I write in my book, it's very important to him. And, you're going to get the forecast wrong some of the time. And people may say, well, you're not credible because of that. But really, credibility, I think there's a dimension to it that is doing what you say you're going to do. And so when they say they're going to do something, I think it means something.
So that's interesting, because that opens up another topic of conversation, which is the chair himself and the extent to which policy is centralized at the Fed. Now, credibility is one of the major pillars that I've depended on to think about what I don't want to say forecast, I'm not an analyst forecasting, but what I've talked about on this podcast before has been that I have felt that this Fed had much less room to maneuver because of the larger issues of credibility that governments have been facing in Western countries, and particularly in the U.S. And this was my position in 2021. In other words, I felt that the Fed couldn't let inflation get out of control to the extent that it had any power over it because of issues of credibility, and also because I did genuinely feel that, and now it's become a cliche, but that Powell did not want to become the next Arthur Burns. And there were certain folks like Mohamed El-Erian and Larry Summers who came out early and were raking the Fed over the coals during that period of time. And so I'm curious to understand his personality a little bit better, how much he cares about other people's opinions, or if it's really, something that you write about in the book is, and you interview a lot of people that talk about this, that he's incredibly confident, that he has a strong sense of confidence and a strong sense, it seems also, of kind of a moral compass, an idea of what he believes is correct, and he's going to do what that is. And one of those things is he's going to do what he says. So my first question is, just to get this out of the way, how centralized is policymaking at the Fed? How much control does Powell have, and how much influence do other people have?
Yeah, those are good questions. In terms of the centralized policymaking, I don't want to miss your question you asked about, critics influencing the chair's thinking on this. So don't let me miss that one. But in terms of how centralized it is, look, this is a large committee. It's 12 voters. It's 19 people who actually participate at every meeting. The non-voting presidents are there sitting at the table and contributing just as much as those who have a vote. So this is a large committee, and that can give more power to other people, but it can also give the chair more power, because anybody who's ever tried to make a decision with that many people, you need someone to kind of come in and say, all right, here's where the consensus is, or here's where things need to go. There's a great exchange in the transcripts in June of 2013. This was when the taper tantrum was really melting up, when bond yields were rising because of people didn't understand what the Fed was going to do when it said they might not continue to purchase Treasury securities and mortgage-backed securities. And Bernanke says, I have to go to a press conference, and I don't know what I'm going to say to answer this very fundamental question about what are we doing here? We don't know. We haven't decided. And people laugh, but he's like, I need to say something. And so I think about that a lot, because at the end of the day, you need somebody to lead people in a place. So I guess that's a long-winded way of saying, even though the chair does not have absolute final say here, he's taken dissents before. He took 3 dissents at the July 2019 meeting when they cut interest rates for the first time. He does set the agenda, along with traditionally the troika. The policy-setting troika is the New York Fed president, who's the vice chair of the FOMC, and then the vice chair of the board. So that's John Williams and Lael Brainerd. They have a series of meetings before each FOMC meeting where they sort of decide, here's where we think things need to go, and then they try to drive the consensus to where it needs to be. So the chair matters here. The chair matters a lot. What I've been told by the people who work with the chair, the other Reserve Bank presidents and staff, is that the chair tends to get what he wants, especially after some of the crucibles that he went through in 2019 with a president who was very unhappy that the Fed had even raised rates to 2% in 2018, and then with the pandemic, that people sort of can grow into the job and they get some, people will support them on things that they maybe wouldn't otherwise want to do because they think this person has earned the right to set policy the way they want. So yes, the chair is very important in terms of driving the consensus, setting the agenda, and trying to get everybody there. I think it's been easier to some extent this year because everybody recognized how far behind they were, especially after the war in Ukraine continued to drive prices up. They thought that the supply chain was going to get better in the first half of the year, and it actually got a little worse. To your question about, do the critics get under people's skin? I don't know the answer to that, but I heard a comment that he had made. This was secondhand, that Powell had made secondhand, and this was after the pivot in early 2019, where they had said they were going to raise interest rates. They stopped after the market tumult in December of 2018. Powell came out a few days into the new year and basically said, well, that's as far as we need to go right now. They had been expecting inflation to accelerate. The unemployment rate had dropped very low, about as low as it is right now, but you didn't see inflation picking up as the forecast had anticipated. And so they decided, well, if the inflation isn't the problem that we thought it was going to be, why keep going? And the comment that I'd heard attributed to Powell was that he said, look, someone was arguing with him about, well, you're going to look this way, you're going to look that way. And he said, look, we're not trying to win an argument here. We're trying to set the right policy. And I go back to that comment a lot because I think that says a lot about what they're trying to do. Yes, it's humiliating when you're wrong, especially in the way that they were wrong last year. But at the end of the day, they can't go back and change that. Powell has talked about this when Trump was getting after him. He would say, we have to control the controllable. When he worked in private equity, there was a business executive. He had worked with George Sherman, Danaher Corp, who had said, we have to control the controllable. And so I think that's another sort of Powellism, is they're not trying to win an argument. You're trying to set the right policy, and you have to control what the part of it that you can control. And the other stuff, I can't imagine it's pleasant, but look, Summers was more right last year than almost anybody else. And so he gets to, people are going to listen to him even more now, especially if he's going to be critical of what the Fed is doing. And he's continued to be quite critical of the Fed.
So what determines what he thinks is the right policy? Because he has said, and the Fed has said repeatedly, that they will remain data dependent. But at the same time, they have made statements about where they expect rates to go. And to your earlier point, it's very important to Powell that he does what he says.
Yeah. Well, I think that all fits together. I mean, you're data dependent. Monetary policy has to be forward looking. So you have to have some idea about where you think interest rates need to be 6 to 12 months ahead. But the data is going to tell you whether those underlying assumptions are right or wrong. Last year, their base case was that inflation would largely fade on its own because it was being driven by these idiosyncratic factors. Maybe that ends up being right. I mean, the great irony here would be that actually ends up being the case, but you've now done 300 or 400 basis points of policy tightening, and maybe that contributed to some of the decline in inflation, but maybe it was going to happen on its own. And then people will say, well, you overreacted, you were embarrassed by being wrong in 2021, so you made the opposite mistake in 2022. But it looks right now like there's a risk that actually, if you look at the ECI, the employment cost index, wages have been running at, 5%, maybe above 5%. That is not consistent with 2% inflation unless you're going to get a huge increase in labor productivity. So there's a risk here that actually you do have more inflation in the system, that, that people are paying attention now. Powell talked about this idea of rational inattention. That is, when inflation is low and stable, people just don't pay attention. But then when something happens in the economy, oil prices, gas prices rise a lot, prices of everything are rising a lot. And now consumers say, oh, okay, I'm going to factor inflation into my wage and price setting behavior decisions. You actually end up in a situation where you transition into that higher inflation regime. And so that does seem like a risk right now. And, you have these, so the two sort of goalposts I think I've laid out, I mean, those are two pretty far apart modalities. And it's hard to set policy for, well, what if, this all just goes away on its own versus what if it's actually really demand driven and here to stay. Aggregate incomes are rising at a quick clip. To the extent gas prices do come down, that just creates more spending power for the consumer that could continue to power higher growth, higher prices. That's the challenge here.
So I should have been a little bit more specific with my data-driven question, which was to really kind of nail down what data the Fed is really looking at, because it seems like they're looking at tons of data, but it seems like they kind of have one variable that they really care about, which is inflation. And so, are they going to stop or change course if some of the other data deteriorates, if inflation continues to remain elevated?
The Fed is so that's all true, but their inflation views are driven by the Phillips curve. This is a labor market centric view of inflation. And so I would pay a lot of attention to wages. If wage growth continues to accelerate or stays at current levels, that is not consistent with 2%. That is too high. They will want to slow the economy. They will want to slow hiring and create slack in the labor market, because that is how they think inflation will come down. I would put a lot on looking at core services right now. Obviously, shelter is a huge part of that. The way that the CPI measures the rent and the housing components, there is a lag. So a lot of the high home prices and rental prices that we've seen this year, even if they've peaked and the growth rate is still high, but not as high as it was 6 months ago, that's not going to feed through to the inflation measures for some time. So, I would keep an eye on core services because that will be important to them. They will see core services as more wage driven. And so, yes, they're looking at the inflation data. You can make an argument that says if you thought it was transitory last year because of used cars and durable goods punching above their weight on the way up, then you should probably ignore that on the way down. You shouldn't take a lot of comfort from that coming down because you thought it was going to fix itself on its own. So what does that leave you? That leaves you with core services. That leaves you looking at wages. And then obviously, you're going to have you already see some serious slowdown in the housing market, and that's going to be lagged. That's going to feed through to the economy perhaps at some point. It's always the case that there's a different neutral rate in different sectors of the economy. So the rate that's going to slow down the housing market is possibly different from the rate that's going to slow down retail sales or manufacturing. And the question is, can you get enough of a slowdown here? And it's just not something that we're used to. We're used to the Fed reacting to a growth slowdown. People talk about the Fed put, where when growth slows, the Fed tries to shore up the equity markets by easing policy. And that held a lot in the last decade because inflation wasn't where the Fed wanted it. It was too low. The Fed wanted to get stronger growth. And every time there was a shock that hit the economy and that jolted the stock market, you could argue the Fed was responding to the stock market. You could also argue the Fed was responding to something in the economy that concerned them, whether it was the China growth scare in 2016 and sort of the mini industrial domestic downturn we had at the beginning of the year, whether it was Europe in 2011-12. But there was always something that the Fed was responding to that seemed to be pushing the central bank away from its goals. Now, I think things are different. The Fed is telling us it wants 2 years of below trend growth. And, someone made this point in a journal story recently I thought it was a great point, that whether we have a recession, a technical definition of a recession or not, 0.5% GDP growth isn't going to feel great. Even, you can go out, the Biden administration can go out and tell everybody it doesn't meet the technical definition of a recession, but it may not feel great. At the same time, if you're having 7 or 8% nominal GDP growth because of what's happening with inflation, that's a problem for the Fed too. And they're going to need to see the economy slow down. And there's no guarantee that you can just fine tune this thing and get, 0 to 1% growth. You could get negative growth. You could definitely get a recession. And that's why you see so much skepticism about this soft landing idea.
Mm-hmm. So we've talked about interest rates. We've talked about inflation. We've talked about employment. What we haven't talked about is balance sheet capacity, specifically the Fed balance sheet, quantitative tightening, which is really the big lever when it comes to slowing down the economy or contracting credit in capital markets. And that also leads to a conversation about financial stability. I want to move that part of the conversation onto the premium feed, Nick, where I also want to ask you about something that I alluded to earlier in our conversation having to do with White House support and the extent to which the fiscal authority, i.e. the government, the Treasury, would need to collaborate explicitly with the central bank in order to get inflation down on a sustained basis. And there's actually a paper that was published recently during the Jackson Hole Summit by economists Francesco Bianchi and Leonardo Melosi, who concluded that if you want to bring inflation down on a sustained basis, that the government itself would need to put forward a credible plan for stabilizing government debt. The argument being that the long-term carrying capacity of developed economy governments is more relevant today than it has been at any point in the last 75 years. And so presumably concerns about the institution of yield curve control, overt debt monetization, et cetera, to cover mounting deficits and interest payments would drive depreciation of the currency and thus persistent inflation. Now, another argument that I think you could make, and which relates to this concept of White House support and collaboration, would take the opposite point of view, which is that one of the long-running goals of Democrats and even more populist Republicans has been to address the widening wealth gap in society. And one way to do that would be to actually run monetary and fiscal policy in opposite directions. In other words, to raise interest rates and thus reduce the aggregate price level for assets relative to wages and earnings, while simultaneously using fiscal transfers to support the redistribution of wealth to lower income earners who are either net debtors or who have very low to no net worth. And while also, I should say, supporting industries and sectors that are key to long-term government objectives in, say, the defense sector, energy, et cetera. Those are just some of the things that I want to explore in the second hour of our conversation, Nick. For anyone new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second part of today's conversation with Nick as well as the episode transcripts and intelligence reports, head over to hiddenforces.io and check out our episode library, where you can also become a premium subscriber today. Nick, stick around. We're going to move the second hour of our conversation onto the premium feed. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription, available through the Hidden Forces website at hiddenforces.io. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.